Unlike many others, we have a one-day forward approach. So our volatility positions are either long or short on one-day forward basis based on statistical probabilities. And there's a lot of talk of like people being short or people being long, and I think that if something works, i.e. the short trade in the last year, people assume that people are very short and vice versa. If it's been going up, people are very long. But like all future markets, there's never an imbalance between long or short, contrary to common belief.
The trade itself is perceived by some to almost have a self-fulfilling aspect to it. And you talked about that predominance of talk around the short volatility trade. Is there an element of volatility per se being suppressed by the proliferation of new product in this area?
I think the main reason why volatility is low is that the volatility in the equity markets itself is low. So if you look at volatility as what actually occurred, realized volatility, and what people look at, let's say the VIX, which is implied forward-looking volatility, that spread has actually widened over the last year versus historical averages. So it's actually a little bit higher than you would expect. So if the market comes down, volatility will come up. So I think it's more of a follower than a leader.
Well, I think this, you point to you make a point that's very interesting, and that's essentially the case that implied volatility is low by historical standard, but the richness of volatility versus realized, or the volatility risk premium, it's actually not as low. It's actually quite expensive, because owning volatility today and carrying the implied versus realized gap could cost a lot of money. So one of the question is how do you explain the subdued level of realized volatility? And I think that's the question that's quite puzzling to a lot of investors.
Yeah, and I think it's like you guys talked about this morning. Earnings growth has been great. People have learned that buying the dip in the equity market works. Interest rates have moved up as of late, but it's still fairly low, so maybe it's more advantageous for people to be in equity markets. We are not saying that equities are cheap and you should buy equities, nor you should sell them. What we are saying is that volatility has to be looked at in a context that it's not that rock bottom versus, let's say, what actually happened, then it's not as low as people think, but it clearly has a lot of upside if something happens.